Well, good afternoon, everyone, and welcome to this afternoon's webinar, obviously focused on the UK economy, bounce back or boom. I'm delighted to be joined by Simon French. Simon's chief economist at Panmure Gordon. He's also regularly appears as a commentator in the media. I've certainly seen him on Sky News and BBC and Bloomberg, and he also has a regular column in the Times. Prior to joining Panmure Gordon, he worked as an economist within the government, and he read economics at Durham University, which I also did, but I suspect Simon was far better student than I was. Anyway, I will now sort of pass over Simon very briefly, just in terms of the format. Simon will run through a presentation for 20-25 minutes or so. Please feel free to ask questions and just use the question box at the end. Some we may take on the way if it seems relevant, and then others we'll take at the end in the last 25 or 30 minutes or so. And with that, I'll now pass over to Simon.
Thank you, John, and good afternoon, everybody. And first of all, a big thank you for both John and the Landbay team for the invite, but also given the competitor at this 2 o'clock slot, there's a test match going on. There's Matt Hancock of the Select Committee. I'm privileged you've taken the time to listen to 20-25 minutes of my thoughts on the UK economy, and particularly given the previous speakers you've had at the Landbay webinars, Professor David Miles, David Smith, two absolute doyens of UK economics. So if I can follow in that series, then I'll be doing pretty well. So what we're going to cover today, and I feel slightly like Chris Whitty asking John to do next slide, please, but if we can move on to the sort of 4 questions that we're going to cover today. These were hopefully as advertised by the Landbay team ahead of this. What shape will the economic recovery take? How will the end of furlough, which comes to the end of September, at least on current plans, impact UK unemployment? Thirdly, how are we going to pay back all this government debt? Of course, the government borrowed about £300 billion last year. It's probably going to borrow about half that again this year. What are the options facing Rishi Sunak in the Treasury? And fourth, and certainly not finally, what is the path for interest rates and inflation? And throughout all 4 topics, I will try and bring reference back to the UK housing market for the obvious reason that the audience are most interested in the read across from these factors to prices, transactions, household incomes, the type of thing that drives that market. So if we can move on, probably 2 slides, in fact, just talking about the shape of the recovery. First thing to say, and I don't think this is any secret, is that the UK is on track for a very, very fast recovery from the pandemic. And a couple of reasons for that. Firstly, it's not really a usual recession, if you like. This normally company balance sheets, unemployment, constrained credit characterizes a recession. And the UK economy, at least since the Second World War, has taken between 3 and 4 years to recover to its pre-recession level of output. Now, if you look at the chart on page 3 on the left-hand side, you'll see, despite a little dip, it's a secondary dip, that is quite a V-shape, arguably a W shape. People argue over the shape of the economic recovery. I think let's not focus too much on letters, but just on our forecasts, and these are largely in line with consensus. I will talk perhaps some of the differentiating features of our view versus consensus in a moment, but this takes you back to pre-COVID levels of output by the end of 2021 this year. So that's pretty much 2 years after the start of the pandemic. So that's quick by historical terms. We won't have had an economic recovery as fast as that since the Second World War. And the other big factor that's at play here is the exceptional levels of monetary and fiscal support that has been thrown at the economy, muting some of the normal constraints in terms of you have company failures and unemployment. And what that tees up on the right-hand side here of page 3 is, in our expectations, 2 years of pretty exceptional growth. We expect 6.5% growth for the year in 2021 and another 5% in 2022. And that's as the economy, you see the social distancing restrictions removed, and some of the activity that had really been held back in 2020 starts to come back on stream, with a relatively small amount of scarring. There is still some scarring. You'll notice, if you just go back to the slide or the same slide, but on the chart on the left, you'll notice the dark blue line is still, dotted dark blue line is still below the light blue line, dotted blue line. That's showing the fact that if pre-COVID trends are continued, there's still a gap emerging, and that is the big uncertainty around the shape of the recovery, I think, going into 2022 and beyond, is how much behavior has permanently shifted, and therefore jobs and businesses are simply in the wrong part of the economy. So if we can move on.
Simon, so can I just ask one question on that, actually, in terms of the recovery? Because obviously in the last week or 10 days, in terms of that final opening up on the June the 21st, and also foreign travel to and from the UK over the summer, some of those things are now looking less likely than they may have done 2 weeks ago, and so maybe restrictions last a little bit longer, and I say there's going to be less travel over the summer than we may have thought in May. Will that have any meaningful impact in terms of your assumptions here, or is actually the restrictions that have been lifted to date are the major ones for the economy?
It's a really good question, because some of the forecasts that are above mine, 7.2% from the Bank of England, 8% from Goldman Sachs, other forecasters in that 7 to 8% range, are conditioned. All economic forecasts are conditioned on assumptions. They're conditioned on no restrictions past the 21st of June. My own forecast is a little bit more cautious than those, because I wouldn't say I had foresight that the Delta variant was going to come along, but I thought it was unlikely you would have a clear run at things past the 21st of June. So I pared back my estimates on the probability that there was going to be some restrictions. So I'm comfortable with where I'm at, but some of the more bullish forecasts in the market, I think, will feel a bit nervous, the fact that 21st of June deadline looks likely to move a little bit to the right.
Okay, thanks. I'll now move on.
So if we move on, the big story as to why the economic rebound will be so strong is that households, and there will be many people on this call who will both be familiar with this story personally, but also some people perhaps who are not familiar with this story, which is households have saved quite a lot of excess liquid assets. Cash or near cash has jumped by anywhere between about 140 and 190 billion, depending on what your baseline is. And that's the chart on the left-hand side of page 4. Now, the hope that that will be spent as the options open up for what you can spend it on, restaurants, entertainment, travel, means that that drawdown should artificially, or not artificially, but a degree of catch-up consumption, which really fuels that economic recovery. Now, there's some hopes that companies also who have also built up some cash resources, will also go on a big business investment splurge. I think I'm a little bit more cautious in that regard, because the chart on the right-hand side here, which shows a big pickup, about £40 billion in corporate sector borrowing. These are outstanding loans. These are these C-bills, bounce-back loans, the degree that companies have had to tap into credit markets. So what they've had, it's been more of a balanced picture. They've built their cash, but they've also built up their liabilities. Their balance sheet is largely unchanged. The big hope here is households rather than necessarily businesses. So if we move on to the final slide in this first section, the test for the UK economy and that shape really emerges later in 2021 as demand catches up. So we have those additional options of spending, but support gets withdrawn. And we think about the end of furlough, the end of rent holidays, those C-bill and bounce back loans liabilities become due, and a bit of a cash flow crunch potentially if the universal credit uplift for low income households and the VAT cut start to come to an end. Will we see a cash flow crunch which challenges that? Yes. And I think that is why there are still some quite significant challenges as you make that transition from crisis management of the economy to managing what is quite an aggressive expansion. So moving on to the second part of this presentation, and this is the end of furlough. The labour market, that's my background, I'm a labour market economist by training. And the good news is that furlough, having peaked at around 9 million people, about 1 in 3 UK employees in the start of the second quarter of 2020, has come down. Not in a straight line, it picked back up around the turn of the year as the second and third lockdowns hit. But actually, we're probably today talking at 2 million, perhaps even a little less than 2 million employees on furlough. It's still a lot of people, but compared to where we were with 9 million, it does suggest that the vast majority of jobs that were protected by furlough are still economically viable and people have been able to return to those jobs. And I would expect by the time the furlough scheme comes to an end at the end of September, we're probably talking about less than or around 500,000 people are still vulnerable perhaps to having to leave furlough and go into unemployment rather than having a viable job to go back to. I think ongoing foreign travel restrictions and some of those structural shifts in our behaviour will make some of those jobs economically unviable, and therefore when furlough comes to an end, there will not be the demand, particularly in that part of the economy. And one of the real challenges we're starting to see increasingly in the US economy, and I think we'll see in pockets of the UK economy, is whether that labour supply that emerges will actually be able to match up to where there is undoubtedly going to be demand. If you think about the hospitality sector in the UK, particularly summer holidays, certain parts, tourist hotspots in the UK, desperate for workers at the moment, whether those workers are actually in the right place with the right skills, with the right propensity to that job is one of the frictions we have to work through. But furlough itself, I'm pretty upbeat, if we can move on a slide, I'm pretty upbeat on its impact, because if you look at previous, and there'll be people on this call who will remember certainly the 2008 recession, and some of the older ones may remember the 1990 recession, some of the really older ones might remember the 1979 recession. These are the profiles of starting at 100, the level of unemployment. It picks up very aggressively, of course, in the early 1980s. But in the last two recessions, generally speaking, from peak to, or to get back to the level of unemployment before the recession, it takes about 84 quarters, around 7 years. Well, and it tended to peak around 3.5 years into the recession. Well, you can see that thus far, that little orange line, for those of you who are able to squint into your iPhones or iPads, you'll see that it starts to trend down already. Now, I do think that's a little bit false in terms of the impact of furlough, having protected from headline unemployment. But there is little doubt, I think, the labour market has been quite aggressively protected and enabling some of the factors that in normal recessions would impact, structural and where skills are in the wrong place, or frictional, where people are going out searching for work. It's less of an issue this time round. And of course, furlough was designed largely on the German Kurzarbeit scheme, which had been in place for many years. And that sensitivity of unemployment to recessions, that historic link, does appear to be broken as a result of furlough. And that is a really positive story. When the chief economist of the Bank of England, Andy Haldane, talked yesterday about, Rishi Sunak having played the blinder. I don't think everything the Treasury have done in the last 18 months has been perfect, but certainly in this regard, it looks at this stage like a very good public policy success. And if we can move on a slide. But there are some things that the Treasury really cannot control. This may be that some of the rotation in demand will be persistent. It doesn't matter whether it's online retailing, it doesn't matter whether it's the commute, it doesn't matter in terms of where we want to live around the country, what type of properties we want to live in. That rotation in demand may mean that the labour, into the form of furlough, but also firms, might be in the wrong part of the economy for post-COVID demand. We simply don't know how persistent some of those behaviours will be. My sense is they will be quite sticky, although there are considerable arguments for why you might actually get quite a decent reversion. If you think about this very webinar that I'm now doing, I get petrified that the broadband is going to fail at any moment and I'm going to be cut off from talking to my audience. And if that fear is widespread, then I can completely understand why people might want to go back to the office to have a slightly better broadband experience that I get out where I live. But also there's a potential, as I mentioned, for structural unemployment, skills mismatches where you've got wrong people in the wrong place and the wrong skills for that market. But overall, I think furlough is likely to leave with a whimper rather than with a bang, which would be a superb policy success for the UK economy. Moving on.
And Simon, on that, in sort of addition to that sort of skill mismatch, obviously the UK economy in a number of sectors has been quite reliant on migrant labour, whether it be from the EU or broader, I say in both skilled and unskilled. And on one side, I suppose you've got Brexit, which makes that a little bit harder for EU nationals. and on the other side, obviously, the COVID restrictions. Even if the UK is fully vaccinated and opening up, it's obviously going to be harder for people in the short or medium term for countries that maybe have higher instances of COVID or vaccine programs aren't as advanced as ours. Do you think that will have any effect, or is that, if it is, it's only a sort of short-term effect? And if so, is Brexit an issue there, or is it more on the sort of short-term impact of COVID?
Answering the last part first, which I think the travel restrictions as a result of COVID are the more material impact here than Brexit. For all the quite febrile commentary on Brexit, the UK migration regime has become less permissive for EU nationals, but actually more permissive for non-EU nationals in terms of the salary threshold to come and work in the UK. So while there are undoubted challenges posed by leaving free movement to workers, actually Brexit is the much more significant impact. And there are estimates on how many EU workers have left the UK, anything up to 1.3, 1.4 million people. I think that estimate's probably likely to be on the high side. But the reality is we simply do not know. And anecdotally, it does suggest that there is a significant loss of flexibility and labour supply that might manifest itself in wages being bid up, but actually may manifest itself in just some industries just not being economically viable in terms of they simply cannot get the labour supply at the price point required to compete in what lots of products is a global marketplace rather than a domestic marketplace. Right. We can move to the third section. And this, paying back government debt, and I think moving just the gear to the UK property market, one of the concerns, of course, is that taxation of property, or taxation of fixed assets, is going to be one of the ways in which the government might seek to balance its budget. And balance its budget is one of the things that, if you look to this chart on page 11, you would perhaps wince if you consider that the UK government ran a deficit of about £300 billion, or 15% of the economy last year, which is about twice the level of what it did after the financial crisis, which of course precipitated the best part of a decade of what was dubbed austerity. There's plenty of speculation that either a repeat would happen on the spending side, or if the public has fatigued itself with austerity, perhaps on the tax side. I'm more relaxed in this regard for a couple of reasons. And I think the first reason to cite is, if we can go to the next slide, is that the picture of just looking at the deficit is a really, really bad way of looking at the public finances. I cannot emphasize that enough. It's a big figure, but it's the wrong figure. It certainly is out losing context. If you look at the chart on the left-hand side here, page 12, this is debt, public sector debt as a proportion of the economy. And you're going to have to really squint, even if you've got a big screen, to see the pickup as a result of COVID. It's just before the line goes sort of parabolic. And that is moving debt from about 80% of the economy to where we are today, about 100% of the economy. But both in the historic past, intra-war and post-Second World War, with debt 150, 200% the size of the economy, and indeed the Office for Budget Responsibility's central forecast of where we're going over the next 20, 30 years, these are much more material debt burdens than we face today. So we have to put the increase in debt in its correct historical context. Then we have to put it in its servicing costs context. And what I mean by that is, how much does it cost the public sector to service that debt, given the interest rates today are close to their all-time lows? And if you look either as a percentage of the economy or as a percentage of total tax receipts, the latest data point for 2020 is that they are towards the bottom end of that range. So the cost of servicing that debt, because of very, very low interest rates, because of quantitative easing, has moved to a very, very modest level, not suggesting that that debt burden and that servicing the debt is going to be a big impediment to the public finances, at least over the near term, while interest rates remain low. And we're going to come on to that in the fourth and final section. But if we can move on another slide, there is another reason why the UK, at least internationally, is better suited to deal with this pickup in debt than other countries. And this is the average duration of public sector debt. This is the average duration of the gilts before they mature and before you have to go back to the market to refinance them. And you'll notice the UK is an outlier, but an outlier, I would argue, in a pretty good way. Its average duration is about 15 years. So if interest rates were, let's not fall into the mistake of being an economist who knows exactly where interest rates are going. I have an idea where I think they will go, but one can never be or shouldn't be so arrogant to assume you know the answer. But in the event that interest rates happen to go much higher, the UK has a term of its debt which will insulate it from big refinancing risk at higher interest rates that might come to play certainly for other countries. You look at the other countries on that list who have a much shorter refinancing cycle and may face those problems, those challenges of funding somewhat quicker. So overall, in terms of concluding this section, first of all, was spending £300 billion the right thing to do last year? Absolutely. We can quibble over whether it was efficiently spent, whether it was correctly targeted, but the cost of doing nothing or doing less would have been considerably more in terms of unemployment, livelihoods, health, etc. So let us not quibble on the fact that the public finances did exactly what they were supposed to do, which is take the strain in a time of economic, or in this case, both economic and healthcare stress. Tax increases and spending cuts as a result of all of this are always a political choice. There is no real funding constraint for the government. There's no one saying to the government, we're really worried about lending to you. They're lending for 10 years at 0.7% as we sit here today. It's always a political choice. And this is what brings you, I think, to the answer, perhaps to the question, which is number 10. So Boris Johnson, the Prime Minister, is what I wrote in the Times last Saturday, fiscally cakeist. What does that mean? Well, he's pretty relaxed about growth and spending, doing the heavy lifting here in terms of the economic recovery rather than tax increases. We've seen from Rishi Sunak, certainly in terms of his most recent budget, putting in place some tax increases from 2023 onwards, that he's a bit more cautious. And I think this is the thing to look for, is who wins that battle of views between the two power brokers on Downing Street. My own view is that the UK government will support the recovery without considerable tax increases for a couple of years. They try and build up exit velocity from the COVID recession. And while some tax increases may start to emerge in 2023 and beyond, we've all then got to play in the political cycle here, which is that it's election year, certainly in 2024, it might even be in 2023. And historically, governments have not raised taxes just before an election. We'll move on to the fourth and final section, and then I'll open it up for questions, which I understand there are plenty. John, did you?
Yeah, actually, there's one question on that actually that someone's just asked.
Sure.
But based on what you've sort of said in terms of actually public debt at the moment is an issue. I mean, this is again a slightly political question and so on as well. Is with that in hindsight, was the sort of austerity policy that sort of Cameron and Osborne pursued, was that a mistake? I'm conscious you may have been in government then as well.
Well, yeah. The benefit of hindsight, it could be seen as a mistake, but, and I think this is a really important point, at the time that those decisions were made in 2009, 10, 11, economic thinking in terms of very, very low interest rates, war and the impact of inflation of quantitative easing was in its pretty formative stages. The International Monetary Fund, two very, very prominent economists, Ken Rogoff, Carmen Reinhardt, were writing about the risk of public sector debt going above 90% of the economy. Economic thinking has really evolved over the last decade, and therefore a bit like, dare I say it, the sort of tweets of England cricketers, if you start judging what is done today versus what was the scenario 10 years ago, you're at risk slightly of applying that sort of dangerous thing in capital markets and economics of hindsight. I think at the time it was the right call, but the economics has really changed. The global economy, in terms of low inflation, low interest rates, seems quite stubbornly fit in terms of that backdrop. And therefore, you can see what the Biden administration is doing in the US. You can see other countries that are saying, well, look, with this quite set in low interest rate, low inflation environment, we can tolerate a higher debt burden than we may have been comfortable with a decade ago. So the final one, of course, plays to that very, very question, interest rates and inflation, and such a sensitivity to the UK property market of interest rates, financing conditions. We may in questions go with what is behind the current pickup in UK house prices, but it's certainly over a 20, 30-year view rather than the most recent pickup. It has been the steady collapse in global interest rates and UK interest rates that has fueled asset price appreciation. But near term, is there a bit of a challenge to that thesis? And I mean, while we've been on this call, the US will have released its inflation rate for May. I haven't actually checked to the figure, but it's probably somewhere between 4 and 5%. The UK is going to see inflation almost certainly above the 2% target as we go through the year. It's currently only at 1.5%, but will it go higher? Yes. Are households starting to expect that? Yes, a little bit. But if you look at the lines on the left-hand side of page 15, these are when you ask households what they expect inflation to be, it's not clear that they are massively out of kilter for where they've been for the last 15 years. So while we're hearing stories of prices in restaurants, prices of builders, merchants, construction, wages in hospitality venues picking up, there is no sense of the really important thing for the long-term path of inflation, which is expectations, have really decoupled. And when you think about central banks nervously raising interest rates, it's when they worry that expectations are right. Well, workers are going to start asking for 3, 4, 5, 6% year on year, and you get a price wage spiral. The moment the data doesn't suggest the households are in that place. But there are other reasons why some economists are very nervous about inflation, and one of them is money supply. Money supply is a concept that used to be very much in vogue in the 1980s, 1990s. Mervyn King, the former governor of the Bank of England, spoke earlier this week about the fact that money supply just isn't being spoken about, the risks of a big expansion in the amount of money in the economy, which has been growing at about 13% year on year over the last 12 months. Whether that generates inflation with a little bit of a lag. I personally don't think so. I think we're going to see a bit of inflation. If you can move on one slide, I think there are still reasons why actually, if it comes, it's likely to be disproportionately in the United States rather than the United Kingdom. And I won't go through great amount of detail in these charts, but only to say that most of the UK bounce back is going to be spending that it didn't do last year, which isn't particularly inflationary over the long term. Whereas on the US, actually the chart there shows that US disposable income is actually higher today because of the stimulus checks than it would have been pre-pandemic, which suggests there's not just catch-up spending, but there's also some additional resources that could fuel an inflationary spiral in the United States. But in the UK, the picture is more likely to be a surge followed by a pullback, in my view. And I think most of the economists' consensus view is that this will be quite a transitory period. And also, and if we can move on a slide, there are some strong reasons to think that the UK monetary authorities, this is the Bank of England, who have pretty much tracked inflation at 2% over the last 20, 21 years on that chart, are probably going to start to get nervous if inflation were to overshoot for any longer, in a way that in the United States they won't, because in the United States they've had a persistent undershoot, and they're now committed to catch up on inflation. So it's perfectly possible that the Bank of England will start to raise interest rates before the United States. And I think most people assume the US goes first, UK second. My view is the UK will probably raise interest rates for the first time at the back end of next year. And the United States, we're going to be into 2023 before they start to raise interest rates.
And Simon, I did actually just look that the US inflation numbers on an annualized basis the last 3 months are 5.2%, so slightly higher than expected.
Yeah, and the point being, I think, in terms of that is on the US chart here, 5.2 starts to eat into that yellow bar below the line. If you think of that as visualizing the shortfall, the US economies have been undershooting 2% inflation. Too many months of 5.2% will start to eat into that quite quickly, but they have the headroom that if we happen to, and I don't think we will, get anything like that kind of print in the United Kingdom, would, the monetary authorities, the Bank of England would say, well, actually, we haven't got that headroom. We're pretty much bang in line with a 20-year average of 2%, and we'd have to raise interest rates. I think the Federal Reserve will sit tight, even with a 5.2% inflation print, which is likely to come down in June. One of the reasons why that print will be so strong is that, remember, 12 months ago, oil prices were briefly negative. So you're always going to get a pretty big year-on-year adjustment when you get a negative oil price. It was an extraordinary period of time, and therefore just annual comparisons are always going to be a bit punchy in this April-May period. But the final reason, if we can go on to the last couple of slides. This is just showing how interest rates globally have just remained very, very benign. And actually, what you find is that the 1970s and 80s, when interest rates were 5, 6, 7, in some cases up to 15% in the United Kingdom, that was a historical anomaly. That wasn't normal. And actually, increasingly, this very, very low interest rates environment is much more consistent with an economy delivering inflation at 2%. And that chart of, to your question, John, about 5-10 minutes ago, back in 2009-10, when the austerity program was designed, you look at that chart, and you go, well, actually, we could be worried that servicing debt at 4, 5, 6, 7% looks quite normal. Well, what looks normal over the last 12 years is very, very benign interest rates, and central banks have set themselves up to keep interest rates pretty low, even as the economy recovers quite strongly. And I think if we go on one more slide, yes. That is where I will sort of finish, if you like, in terms of my view on inflation and interest rates. Those central bank views are heavily skewed now in favour of supporting output and employment, which was very much a reverse of what they had in the 1980s, where they were worried about inflation. So it's very much they will support the economy and employment and getting people off furlough, back into work, getting people back into the labour supply, almost at all costs, and they're prepared to see a near-term overshoot, even in the case of the US, 5.2% on inflation. They'll look through that with a view to trying to get the economy back on its feet. Secondly, persistent inflation, as I mentioned earlier, requires losing control of expectations. It's not clear that households or businesses suddenly now expect us to get an era of 3, 4, 5% inflation. It tends to be the household, business, worker expectations still remain pretty well anchored. And the final and most important point is that there are still big issues to deal with in terms of deflation, the kind of characteristics of the last few years where the digital economy, the aging demographics, increasingly remote working has pushed down the price of price growth. And actually, in that economy, a sustained period of inflation like we saw in the 70s and 80s, where wages and prices, in little regional monopolies start feeding off each other, is just not the modern day economy, and therefore it's unlikely we're going to see anything like that dynamic returning. And I'll finish with this final sentence, which is the good news here. And I think one of the reasons why the UK economy and in terms of the housing market, the really upbeat story on why this might be a sustained rebound in both consumption and sentiment is there are good reasons to think of a productivity rebound, which has been a real dog of an economic indicator for a decade. We might be on the cusp of that. One of the reasons why productivity has been so bad in the UK is that digital skills were a real very poor record on it, both from workers and in terms of businesses engaging with digital channels, online channels, sharing information. Out of necessity for the last 12, 18 months, most of us have had to make more use of digital tools. So that digital penetration, those skills that have held back UK productivity, we've had a forced, what I've written in my writing, had a forced training program in that. Some of us better than others, but I'm still a bit fat-fingered with these things. But yeah, I think most people have had out of necessity to move towards greater engagement with digital channels. And that should be good news for UK productivity going forward and the sustainability of the UK economic recovery.
And on that, Simon, obviously Andy Haldane made some comments yesterday. I don't know whether it was in a speech or an article, but he sort of, I think, said it's the highest risk of inflation since Black Wednesday or something to that effect. And I think he has been sort of quite hawkish. That's something you don't really subscribe to, by the sound of it.
Not really. I like Andy. It's worth saying a few things about that. First of all, in the interview he did with LBC, he's a month away from leaving the Monetary Policy Committee and take up head of the RSA. So he's a little bit demob happy, and perhaps he's sort of feeling a little bit sort of less constrained than he was when he was had an open-ended tenure on the Monetary Policy Committee. But he's also been very, very hawkish in the parlance of central banks, so concerned about inflation and higher interest rates for pretty much the whole part of this recovery. But he is one of 9 policymakers, and he's soon not to be one of those 9. And the rest of the committee, the rest of the Bank of England, the rest of the central bank committee globally tend to not think like Andy thinks in terms of the risks of inflation. So he is an interesting view. I've always found his views very interesting. I just don't happen to agree with them.
And related to that, I have a few questions on interest rates. I know, without trying to sort of get the crystal ball out, we've been, as we've discussed before, interest rates have been sub 1% in the UK, sub 1% since the crisis. For most of that time, they're below 0.5%. And actually, in real terms, they've been negative for pretty much most of that sort of 11, 12 years. And at the same time, we've sort of always seemed to be 12 to 18 months away from interest rate rise. That's what generally is a sort of, and we seem to be sort of back in that sort of world now where we're 12, and maybe they do go back up to 0.25% or 0.5%. But when they do start moving, and whether that's 12, 18 months away or 3 years away, are we in a new normal from an interest rate perspective, or will we see the heavy days of 4 or 5% interest rates again?
I would be very surprised. I think, take for example, the Bank of England don't publish what they think their long-term estimate of R star, or the US interest rate, the UK interest rate is, but the US does. And they think the long-term US interest rate is about 2.5%. And if you think that the UK has a slower growth profile, our estimate internally is the long-term top of cycle interest rates in the UK is about 1.5%. So yes, there's 140 basis point upside from where we sit today. But as I say, there will be people on this webinar who will remember much, much higher interest rates, not just 4 or 5%, but much, much higher. The global economy is just very, very different in terms of the inflationary risk. So much more of the global economy is now tradable, and therefore the ability for individual companies, individual workers to bid up wages and prices is much more constrained. And therefore, the degree to which interest rates have to lean in against that is much reduced. And so I think interest rates will go back up, from their current levels. I don't think they'll go negative. But I would argue that if you're worried about 100, 150 basis point move, you've got bigger issues in terms of your investment than that interest rate move. It tends to be that we are in a cycle globally of very, very low interest rates. And if you think about Japan and the Eurozone, they're going to be stuck very, very close and indeed negative in their cases on interest rates. And if it was that the Bank of England tried, let's say, to go to 2, 3, 4%, of course, that gap between the interest rates on offer in the UK versus the Eurozone or Japan means that sterling would move much, much stronger. And that starts to become in itself both a deflationary force and indeed start to affect the terms of trade of UK exporters. So one of the reasons why a single country, even one that's the world's 5th biggest economy like the UK, can't decouple, and I'd argue the US, the world's biggest economy, also can't decouple, is that your exchange rate starts to sort of take the strain and starts to mute the very inflationary pressures that led to those interest rates in the first place. So it's a little bit like squeezing a balloon.
Okay, great. Well, we'll now move to questions. I've got a few that have been sent on. So what I'm going to do is I'm going to stop stop sharing the screen now as well, and please do continue to send the questions in. I'm going to ask a couple that we've had in on housing and the housing market, and obviously quite a lot of interest. Obviously, house prices have had, since sort of the first lockdown sort of opened up in September, October, and the summer of last year, house prices have been sort of extremely strong housing market. And do you have any sense of how much of that is down to sort of what Rishi Sunak did around stamp duty? Do you think it's structural? And obviously those stamp duty changes will finish at the same time as furlough comes off and all the other government measures. And then, obviously you could then see maybe not a crash, but a sort of flattening of some sort.
I don't think so. I have fairly strong views on this. I'm pleased we left it till the end, because otherwise there's danger I got bogged down in during my presentation. Certain members of the Monetary Policy Committee think that this is the Bank of England Rate Setting Committee, think that it is mainly a stamp duty effect. I don't. Why don't I think that? Well, if you look across the G20, which you would think is the 20 richest countries in the world, it's actually 19 countries, but across those 19 countries, 18 of them, with Italy being the one that isn't, are all seeing residential house price increases at a pretty rapid rate. And arguably the UK is a less hot market than some of the markets like New Zealand, Canada, Sweden, some countries that are seeing extraordinary price growth. As far as I'm aware, I did a bit of research on this, they haven't had something equivalent to a stamp duty cut. So it suggests to me that there is a much bigger issue at play at the moment, driving asset price appreciation in residential housing. And it is that most of us, lots of us, have spent 24 hours a day in our homes rather than 12 hours a day. And therefore, in economics parlance, we are ascribing a higher utility value to our home. And therefore, we are prepared to pay more to get that additional space, better sort of balance in terms of your work and home life, particularly if you're anticipating that will be a permanent shift in terms of spending more time in your home versus the office. And as a result, your very good point, which is as furlough comes to an end and the stamp duty holiday comes to an end, would that precipitate a crash? For the reasons that I don't think it's the source, albeit I would fully acknowledge that it has added some further heat, but it is of a degree of magnitude smaller than the big structural shift here, which is driving house price appreciation, which is the utility value rather than the tax changes.
So then I have a sort of, I suppose then a sort of policy question on that in terms of what Bank of England or the government for that matter might do. So there's then a scenario potentially where we have house price growth of 6, 7, 8%, whatever it might be, but significantly above inflation, and inflation, let's say it does stay, around about 2%. Is that something the central bank or government will worry about, where house prices are rising significantly above? And would they come in and raise interest rates, even if inflation was under control, but to try and stop that or slow down that house price growth? Or would it be left to the government to try and meddle around some other way? Or would they just think, well, actually, inflation's fine and therefore we don't need to worry about it? Yeah,
John, you're very much in danger of getting me onto my soapbox here, but I'll try and keep the answer factual, which is, for all the attention that interest rates attract, and for very good reasons, there are other tools in the Bank of England's toolkit that it prefers if there is a particular sectoral risk. And in the case of house price inflation they may feel uncomfortable with, there is the counter-cyclical buffer for lenders. There is the LTI and LTV ratios, the 300 basis point affordability test. These are all known as macroprudential or indeed microprudential part of that toolkit. And if it is something sectorally based, I think they will stick with interest rates and quantitative easing to control the inflation print and move to those macroprudential tools to control a particular sector that they may feel uncomfortable and presents financial stability risks. My slide soap, I promise you can't keep me completely off the soapbox. The problem, of course, is that the Bank of England and the Treasury are not on the same page on this one. The Bank of England does have some concerns in terms of financial stability risk, does want to play with its macroprudential tools, but this is at the time that the Treasury have tried to open up the 95% loan to value marketplace, and it is trying to promote home ownership. So it won't take kindly, I don't think, to the Bank of England trying to lean in against that with macroprudential policy. It feels to me very much like the left and the right hand of economic policy making aren't on the same page here, and that lends itself probably to a degree of inertia rather than a strong push one way or the other.
Yeah, that makes sense. And sort of in the first sort of part of your talk, you talked about obviously government debt and how I don't think you said we don't need to worry about it, but obviously it's not as alarming because of the thing. There must be a sort of certain interest rate where it starts to get worrying, if that makes sense. And although we've locked in the rates for 15 years, we're not going to pay this back for quite a while. And is there a sort of certain threshold where if the cost of borrowing for the government hits 2%, 2.5%, it suddenly has a real implications for the taxpayer fundamentally, whether it be them taxes going up or cutting public services, etc.
Yeah. So there's a danger of getting down into the weeds of the detail here, but I'll briefly go into them and then try and come back into the sunlight for a moment, which is that 15 years on the average duration of UK government debt can be a little bit misleading because of quantitative easing. So as a result of quantitative easing, the Bank of England owns about 40% of that debt. And if the bank rate starts to go up, then the interest paid goes up immediately. It doesn't wait 15 years, it goes up immediately. Because the bank, effectively, because the accounting process between the Bank of England and the Asset Purchase Fund that holds these gilts. And therefore, as a result of that being a problem, would there be huge political pressure to let inflation take the strain, if you like, and not respond in terms of bank rates? I think that is one of the risks, which is a way of saying why it's very difficult to go with a sort of 3% or 2.5%, or at some level you start to get real pain. I think if you got bank rate to that kind of range, again 2-3%, then the impact on the public finances in terms of debt servicing costs would be that would come straight out of the budget for defence, for education, for health, and therefore I think there would be a real question mark actually for the for both the Treasury and the Bank of England, whether the mandate that they currently have, 2% mandate, is tolerable. And I mean that in terms of political tolerance rather than economic tolerance.
Yeah, that makes sense. And you've talked, I think the downside risks, I think we're probably all aware of what they might be. Say there could be some unemployment spike in furlough. Inflation could rise faster, so that might bring interest rates forward. Obviously, new variants, which is something that obviously has come into play in the last few weeks again. That means that open up takes a long time. Can you see any sort of big upside risks as well? Is there sort of I mean, you're quite optimistic. Your forecasts are quite optimistic, but actually, is there a sort of sense that things could be better? Because I sometimes think that in our business, what we've had really since mid 2016 is either uncertainty around Brexit, political uncertainty, whether it be Brexit related or the risk of rather hard left government getting in, or even a hung parliament, so decision making can't be made, and then COVID with a space of probably of 2 months, in January and February 2020, and so suddenly we're now in this place where actually those big macro political risks have gone, and actually you could have 4.5 years worth of pent up investment demand that actually gets put into the British economy.
Yeah, so there are definitely upside risks, and I will go through those upside risks, and then I'll explain why, to some extent, if they start to crystallize, you get a bit of an automatic stabilizer in the economic system. So first of all, the upside risks. So of the 140 to 190 billion pounds worth of excess household savings, our estimate is that about 10% of that will be spent. 90% of it will be saved. That's because it's disproportionately amongst middle and high income households for whom their marginal propensity to consume over their marginal propensity to save is relatively low. But that may be too pessimistic. It might be that 20, 30, 40% of this will be spent. And therefore, my forecasts are pretty low-balled in that scenario. The problem with this is we've had a 1 in 100 year pandemic. This hasn't really got a historical parallel, certainly not in the current market economy. And therefore, those 10% estimates, I think another bank is out there with as high as 20%, but they're still, comfortably the minority. They're all based on surveys asking households whether they will spend, whether they will save. If that is if it's a bit like sort of Boaty McBoatface, the sort of surveys yield a slightly perverse, odd result, and actually households, as soon as the unlocking happens, they'll just splurge the lot, then the upside risk is very, very considerable. But we have to, as always, as economists, pick an assumption based on the information we have, however imperfect. And at the moment, that a considerable minority will be spent rather than anything like a majority is one of the reasons why we're at 6.5 rather than, let's say, we collapsed by 9.9% last year, why we don't see a 9.9, 10 or even higher increase this year. So that's the first upside risk. The second upside risk.
Can I just say on that? Sorry,
yeah.
on that, I suppose there is a point. The survey data is a little bit like if you probably ask people in the beginning of January, do you tend to go to the gym 4 times a week? Will you do it? So there's probably an element where people are probably doing what they want to do rather than what they will do, I suppose.
Absolutely, absolutely. So we must have a sufficient humility as economists to know that assumption is based on data which could very quickly change, could be imperfect, and could lead to some quite significant revisions. But the good news, I guess, is they will be revisions probably almost certainly to the upside. The second big upside risk is the political risk. And I mentioned in the intro, you had some very, very respected speakers on previous webinars, Professor David Miles, David Smith. Going to my background, or my most recent background of Panmure Gordon, and we're an investment bank, stockbroker, what we've seen is that 4 or 5 years of pent-up demand as a result, not of COVID, but because of a succession of political risk. I mean, I remember first joined Panmure, it was a few months before the Scottish referendum. And I thought, well, I can cut my teeth in a bank by a little bit of politics, and then I can start to do the sort of financial market stuff. But the political stuff kept coming. Then there was a general election, then there was Corbyn, then there was the referendum, and then there was Trump. They just political stuff kept. And there were lots of reasons why the UK capital markets, business investment, kept missing to the low side. The stock market materially underperformed for 4.5, 5 years. Now we're starting to speak increasingly to US investors who basically said, right, well, we're not going to get involved in the UK because we've heard of, this Brexit issue. We've heard of this guy, Jeremy Corbyn. We don't want to play. We'll just be underweight the UK and we'll live with that. But now you're starting to see them both take those short positions off and now actively start looking at UK companies. There have been 43 M&A, merger and acquisitions of UK publicly listed companies so far this year already, by the end of May. There have been 33 IPOs, which is the fastest rate of IPOs since before the global financial crisis. The capital markets, stock markets as an indicator, are showing that business investment and sentiment is really starting to pick up, and disproportionately in the UK, because those political events have, while some of them have been global, a lot of them have been UK domestic, and that, at least at the moment, that seems a more stable backdrop. So that's the second reason why you've got some upside risk. And the third and final reason why I think there's potentially some upside risk is just pure animal spirits here, which is, it does feel a little bit like, it was going to be the 21st of June, but whatever that moment is, a little bit of a sort of post-war sense of, enthusiasm, devil may care levels of activity, spending, etc. Really tough to model that, and one has to make an assumption. on where sentiment goes and how it feeds through in terms of activity, sentiment, hiring, business. But there are early indicators that there's some real enthusiasm bubbling under the surface there. And again, that could surprise even more to the upside than our central assumptions.
Well, I think on that sort of optimistic note is a very good place to finish it. It's approaching 3 o'clock now, but first of all, thank you very much, Simon. We sort of had an hour. We've sort of really been through the UK economy from sort of every angle, and I certainly found it extremely informative, and certainly some of the comments we've had agree with that. And I'd like obviously to thank everyone for dialing in. There will be a recording available, and Simon has very kindly said that we will be able to share his slides as a PDF for those that want it. So I'd like to thank everyone for dialing in, and once again, thank you very much, Simon.
Thank you, John. It's been a pleasure. Thanks, everyone.